keep looking. All right, we're going to begin.
And this year.
I want to welcome everybody to
Part of what we do.
the What's the Deal with Deals. Before we get started, I want to first of all I want to thank Kirkland and Ellis and their outstanding staff for allowing us the space, their beautiful space, and their technical crew, which is top in the industry, and we're honored and privileged to be here. I also want to thank RSM McGladrey and Bill Spiesman and Linda Peddle for co-hosting the event and being a part of it. We enjoy working with both of them, and we're glad to have the opportunity to co-put on this event and partner in this way as well as on M&A deals. And I also am very excited for today. I think as everybody could tell, and it's why we have such good attendance, is we have such a top quality panel. And people are like, well, how do you get such good panelists? And I say that the key is you ask them. And we had this time, as I think you can tell, we had the top choices, just kind of vision who would be the best people to tell everybody what's going on with deals and successful people. And we're honored to have this panel and the panel following. So we're going to keep things, we're going to have about 1 hour with this panel and then about 1 hour with the second panel. And the idea is to be informal and just kind of learn out what's going on. This is not meant to be how to do deals better or how to learn. This is kind of from insiders, what's going on, and it's for all of you guys. Any of you probably could be on the panel, so everybody's day-to-day is like, what is going on in our world, the deal world, and I'm looking forward to hearing what everybody has to say. So having said that, I'm going to start, and we're going to introduce our panelists on this panel, and then we will turn it over and start having the conversation on what's the deal with deals. The first panel will be on M&A, and the second panel will be on lending. So if everybody just doesn't mind telling a minute or two about what you kind of do in the firm you work at. I appreciate that, so everybody knows who's talking. Bill, if you want to talk, and then we'll come through John, and then we'll start again.
So I'm Bill Spiesman. I'm a partner with RSM US, formerly McGladrey. We changed our name about a year and a half ago. And I lead our Great Lakes transaction practice. We have a group nationally of over 300 professionals doing M&A due diligence, tax, financial tax, operations, IT, and valuation work. And that's a practice that we formed in 2007 on a national basis, and it's been growing at a compounded annual rate of 20% or more over that period of time. And we're very proud. And RSM is a middle market. We're the 5th largest accounting firm focused on the middle market. And PE and family offices are a major part of our business. And nice to have clients on the panel. And I'll turn it over here to John Hatherley.
Thanks, Bill. I'm John Hatherley. I'm the founder and managing partner of Winchurch Capital. We're a $2.3 billion private equity firm which was founded in 1999. We have offices in Chicago, Los Angeles, Toronto, approximately 30 professionals, including the investment team, and then we have former CEOs in residence, and we have operating partners. So we have a cadre of operating folks on our team. Our focus is really buying businesses that are well-positioned companies at good value where there's an opportunity to either improve the business or grow the business, and in partnership with the right management team to lead that effort.
Hey, John, when you started Winchurch, did you have a vision that it would be what it is today, or just...
I'd like to say I did, but I certainly didn't, quite candidly. I borrowed $1 million from a wealthy Canadian with the goal of starting a private equity firm, not with a vision as to where we are today. And we raised $160 million in our first fund back in 1999, 2000, and it's gone pretty well since then over the last 17 years.
Would you say your philosophy on how you do approach and what you're looking for is the same, or it's really evolved?
Well, it's certainly evolved in terms of being far more disciplined today than we were back in 2000, far more cautious today. But you learn a lot of lessons over that journey, and we've put those lessons to good practice, and our volatility of our funds has declined dramatically with each successive fund, and our returns have actually improved with each successive fund as well.
Thank you. Brian?
Excuse me. Brian Borstein. I am a partner at Granite Creek Capital Partners based in Chicago. It's our headquarters. We have multiple offices, but they're all contiguous to each other in the office itself. Didn't go over very well. We are focused on the lower middle market. We consider ourselves active managers of the businesses. We play up and down the capital structure, so we eschew flexible capital. We'll do control equity, minority equity, mezzanine, senior debt, dip loans, bridge loans, and we think wherever we think we can get a good risk-adjusted return. By and large, we're looking for high growth companies with rock star management teams, as everybody else does. We focus mostly in smaller growth companies. That's more the expertise in dealing with all the concomitant problems that they face: financing, acquisition of management talent, acquisitions, and growth. We manage a few funds that focus on basically private equity. We also have a fairly large real estate fund, and we've branched out to do other things like activist deals and things that we find and come across the transom. We think we can make a good risk-adjusted return.
You think private equity is harder than when you were at Heller or Dakota now, or then?
I think it's actually much easier than it was decades ago. You witness the people in this room. I'm sure if we had the ability to introduce each other, we would find there's across many different professions and activities. In really what's gone from a nascent industry of leveraged buyouts now to a full-fledged asset class that's got multiple layers. It's got participants that didn't exist before. If you went back to the mid '80s, there weren't any natural deal flows. There weren't there weren't accountants. There weren't mezzanine people. There weren't people focusing on this business. So I suspect that if we took a poll of everybody in the room, nary a person has not done a deal in the last year, because the deals are out there and deals get done. There were years, long time ago, we had to convince people that this was a viable option, and so you had to go look between the bushes. Now there are ready-made sources. There's liquidity within the brethren of this room, and so I think it's gotten to be an easier deal. It's never easy to make money, though.
A lot less competition then.
Well, yes and no. I think that there's, in my opinion, there are more deals than there are money or people chasing deals. It's just a matter of you're looking for those deals where everyone else is looking for those deals. So most people, who manage a fund may look for volume, but at the end of the day, they don't really do a volume of deals. So my belief is if you know what you're looking for, or what you're looking for makes sense with what you fit, you can go out and find those deals, and you can negotiate deals. You don't necessarily have to chase the deals.
Yep. John?
John May. I'm the new kid on the block. We're a recently formed private equity firm in the last 6 months. We focus on the lower middle market industrial segment, so we're very sector focused. We're very opportunistic in our mandate, kind of distressed all the way through growth and consolidation plays. About to launch our first fund.
But you're not new to private equity.
Not new to private equity, 17 years with a number of bigger sponsors like HIG, Blackstone, and a few others.
And also you've co-founded Emerson Angels?
Yeah, I founded a nonprofit here in town. It's a one-on-one cancer support organization where we match people fighting cancer with someone that has survived that same type of cancer.
Very nice. Raul?
Well, first, let me thank you, Tom, Ravinia Capital, RSM, and Kirkland for this event. It's a great event. Obviously, highly accomplished.
We're glad you're here.
Well, thank you, and the audience is amazing. It's So thank you for that. My name is Rahul Sani. I'm a partner with Z Capital Partners. We are an asset management firm with $2.3 billion in regulatory assets under management across private equity and credit strategies. On the PE side, we are investing out of our third fund. I would say we are value-oriented middle market control investors. What that generally means is that we invest in companies between $100 to $400 million in enterprise value, primarily in U.S., Canada, and Western Europe. What that also means is that we're value orientation is across different types of transactions. So certainly we've been known for distressed private equity transactions 15 years ago. That is and will continue to be a large part of what we do. But we also have the benefit of close to a dozen operating partners, functionally siloed, that help us in other types of value-oriented transactions as well, which would include corporate carve-outs, go-private transactions, consolidation opportunities, et cetera. And frankly, given where we are in the cycle, we have been doing more of those lately than not. We are industry agnostic, so we have invested in industrial companies, automotive companies, consumer products businesses. We're licensed in 5 states from a gaming perspective as well, so we own casinos. So it's quite diverse.
Where did you first start enjoying doing deals? Where were you working?
Well, I spent 10 years first in J.P. Morgan and predecessor firms. I think I'd say I got my teeth there. Then I joined a predecessor firm to ours called Black Diamond Capital Management, where I was recruited on the PE side. And then, we founded Z Capital 11 years ago in October. So, this is, like I mentioned, our third fund as Z Capital, but certainly have been investing prior to that as well.
Yep. And Tom Goldblatt with Ravinia Capital, and we're an investment bank. We've got a new tagline that we came tailored approach, extraordinary results. We're really excited about that because I think that represents what we do on the deals, particularly on sales, and we operate at the heart of the middle market. And we've been finding more and more as we're growing and stuff how we're different. And I think that the biggest thing is that we approach deals and see the companies not just kind of as it is, but what it could be. And then if there's a problem with the company, we don't just kind of represent that in the sim or something, then we actually will recommend making those changes. We've gone to China on deals and renegotiated contracts to lower price. We put in new CFOs. We're working on an opportunity now that they wanted to sell quick, and we're like, well, they didn't have a sales force and marketing. They're just saying, well, we're like, well, let's bring in a sales consultant. Let's make a sales plan, and then we'll sell off that. So we're seeing that we, on the sales side, can create difference and competition through our processes. So we're real proud as we're learning how we differ and growing. Thank you, everybody, for being here. And now looking forward to hearing what's going on with the deals from the panel. And so
okay.
I'm going to have Bill start it off.
Over here.
Do you want to control the...
Oh, sure. I guess I could have done it without
Thanks.
standing up. But when you're 6'9", you like to stand up. It's an advantage.
He's the tallest Jew I know.
David Gregory didn't think that. David Gregory thought he was. So I pulled some slides from PitchBook that I thought would be meaningful for everyone. And a picture says 1,000 words. So this is really the dry powder. Really hasn't changed much. It's just under 740 billion. So there's a lot of dry powder out there chasing deals. And if you look at the middle market M&A transaction multiples, it's creeping up in the first 6 months of 2017 to 9.9, up from 9.6. This is just an average based on what's reported to PitchBook. And you can see there that the debt and EBITDA multiples, so the debt's at 5.3, up from 4.8.
John and Brian, I mean, when you look at this, it's almost because if you go back to the 90s and 80s, I mean, these are high multiples, right? I mean, like
by historical standards, they're high multiples. But Brian raised a point. There are a lot of opportunities out there. You just have to focus on what's the right opportunity for your firm. And we still find unique businesses that we can buy at 5 times. Albeit we see a lot of businesses we could buy at 9 or 10 times. We just choose not to pursue those opportunities.
There's also I think if you take a look, if you look historically at data, it would show that the buy-in multiple is not necessarily the criteria for success. Certainly if you overpay, you have a higher likelihood that you may have a restructuring on your hands. But what's gone on, as I was alluding to, is as the industry has matured, the buy-in multiple and the sell multiple, the delta, hasn't really changed that much. What is probably the most important part of all of our worlds is liquidity at the time that you get out. So if there's any way you could take a cross graph versus the buy-in multiples and overlay that to the time that you're trying to or need to get out and see what the liquidity is, that will show how well you've really done. Now, to John's point, he's finding some things at 5. He's not necessarily stealing these things. He's finding those things because they add value. They're developing stuff. Like if you think about real estate, you can take a building, you can do the discounted cash flow of the leases, and that's all you can really do. You pay a cap rate, you're on your way. Or you can buy a vacant land and build a building, and that's where you can get the multiple creeps that he's talking about. He buys at 5 and sells at 8.
Yeah, the other thing I would say, values are relative. What you do with the business. You can buy great businesses at 7, 8 times, and that's downright cheap if you have a thesis as to how you're going to improve the business, grow the business. So once again, it's all relative. You need to, the most important thing is developing that investment thesis on the front end before you buy the business and execute the plan that you've laid out.
And lastly, then I'll go, is Bill pointed out that it's the debt and equity. There was a point way back when a true leverage buyout, you borrowed 90 cents and you put in 10 cents. Now it's different, so the multiples are up, but again, the buy-in multiple and sell, and the real question is are you risking return on capital or return of capital? I think that it hasn't really changed that much depending on when you get out.
Those are great comments, and the other item is that there could be, some of these could be add-ons. You don't know if they're platforms or add-ons, and oftentimes the synergies from an add-on can provide, you may be buying it at that multiple based upon reported EBITDA, but with the synergies, it might be different. Might also be some pro forma adjustments and things as well.
I think it's being driven by the low interest rates and the lack of good alternative investments, and so people are willing to pay more for these private investments at this point. And then there's a lot of liquidity looking for homes.
Well, I think people are willing to accept lower returns, and that's going to be, I think characteristic of the industry. You'll see returns compress somewhat. Doesn't mean you're going to put your capital at risk per se, but you may be giving up a few hundred basis points of overall return.
Mm-hmm. So here's the U.S. M&A multiples. It's just a little bit higher, and you can see that it trended down a little bit year-to-date 17. Not much. This is kind of an interesting slide. This shows the PE activity, and you can see year-to-date 2017, the activity is a little bit lower than on an annualized basis compared to 16, but you can just see that the transactions are trending down on the PE activity.
It'd be interesting, too, to see how many deals now are PE to PE. Versus in the old days, like that was a rarity, and now it's a lot of them are traded 6 times.
I think it's a pretty common occurrence that every PE firm thinks they're smarter than the last PE firm, and at some point the music will stop, and you'll figure out who was really smart or not.
We've done well enough on this; we can turn it over to someone else and let them, just like probably an investment in a public stock. I've made my gain. I'll turn it over.
Well, actually, again, as we all know, sometimes the function of when you sell is not necessarily that the company has maxed out. So, the buying PE firm is coming in wide-eyed and attentive. The selling firm may be in its 8th, 9th, 10th year of its fund, and it's time for them to get out. So. I don't think that, when you sit at the table and you try to figure out where the dumb money is, the table can't figure out, it's usually you. which happens to me often. But I think that people are there's a lot of smart people. There's a lot of competition. People are smart people, and they're getting in for different reasons. Maybe the slope of the line's different. Maybe it fits their money. Maybe they just have to do different things.
I think also from part of what we sometimes focus on is buy and build strategies. If you're consolidating a fragmented industry, for instance, you have to leave something on the table for the next guy. Otherwise, the market for your exit is reduced. If you've consolidated a large portion of it and there's not a lot more to do, then what's the next guy going to come in and do? Even if they think they're smarter than you, what are they going to do with the business? Maybe they can make it more efficient, but to really drive returns and make an asset attractive, you can take it a certain part of the way and leave something on the table for the next guy. So,
John, you guys are just getting it, but you've got an operation focus.
We do, but we like the process dynamic side, as Brian was mentioning. If someone's at the end of a life of a fund, that's more attractive to us than not. But most of the companies that we're looking at are more baby boomer led, entrepreneur led, less buying from a PE shop.
How is it raising a first fund now?
Capital is out there, but nothing's easy, especially starting right now. It's just not easy.
I mean, John, it's probably easier to raise $1 billion now than it was to raise the first funds.
Oh, absolutely. But once again, the challenge is you'll find once you have successive funds, it's not raising the capital, it's deploying the capital in an intelligent manner, and that's really, I think, the challenge today.
I agree with that. I think, obviously, as you said, if you're raising similar sized funds once you're in the second or third fund, you have a base of investors to work off of, so that makes it certainly easier. And I agree with John. I mean, especially in these types of environments for value-oriented investors, it's tough to find the right opportunities.
I'm going to state the most obvious of obvious things, not trying to be pedantic with John's thing, is it's not putting the capital out, it's getting it back. And if you're trying to if you're trying to get it back at a time that's down, if you go back to 08, 09, there was nothing you were going to do. And so the best thing you can do is obviously build for perpetuity and hope that you're in a part of your own life cycle. This is a fun speaking, your own life cycle where you don't have to get out. You pick your time based on a myriad criteria, some of which are what's the ability to get out at that time.
The next slide here represents the percentage of buyouts that are add-ons. And it's actually 64%, and it's held pretty constant at 64%, which kind of emphasizes and explains the PE strategy by the platform. Then do the add-ons to tuck them in, and you can just see that percentage has stayed rather constant.
I bet you guys have really seen over the years, though, what makes a good add-on versus what does not work.
Well, we've made a lot of add-on acquisitions. In some cases, you have a platform that's not doing well, and you think you can buy things to average down and make it better. Generally, the wrong reason for making add-on acquisitions. So you've got to find businesses that are important strategically to the underlying platform business for them to really have a chance at success.
So people always say, well, what do you do? I said, I'm in the M&A business, and depending on when times are, I'm usually more in the A business than the M business. Because the M business is a lot more difficult, usually because there really are no two companies that are run the same. So you're increasing the operating, you may be driving operating leverage by buying something, but you're markedly increasing the operating oversight and trying to merge the cultures are extremely difficult and risky.
Yeah, I would say the culture is the key word, especially as you're talking about smaller businesses. The culture is so important, and we've found it's difficult to put those businesses together when you have two different cultures.
This slide presents deal size, and you can see that the categories from 100 million to 500 million and 500 million to $1 billion have really kind of increased there. And the lower end of the middle market, 2017, is smaller.
Huh. Looks like it could be at Museum of Contemporary Art.
It's abstract.
Here's kind of a very interesting slide. This is the exit activity for PE, and it's a seller's market. And in 2015, In 16, the number of transactions, the number of exits were higher. It's trending lower in 17. Not sure if there's another slide that I'm going to show here, and I'm not sure if it's the next one.
It looks like if you go back, though, I think it's interesting. If like 2009, just how I just remember, the banks just really stopped lending, and I remember kind of like nobody would make cash flow loans, and then PNC kind of came out of it and started lending, and then I saw Michael Malley here. He was at Wells. They started lending, and then by 2010, just about everybody was back in, and now it's a free-for-all.
Right. This next slide shows the exits, whether they're by corporate acquisitions, by IPOs, or secondary buyouts. And just the IPO trend is trending back. It kind of trended down. It's kind of trending back, but still not at the 2014 level. But the corporate acquisitions and secondary buyouts are about the same percentages.
Raul, John, do you guys look at IPOs as exits ever or often? Or?
We do. I mean, once again, the nature of we're buying more industrial type businesses. Unless you have some real scale, like $1 billion plus, it's difficult to IPO industrial property. But we've done IPOs in Canada with some of our businesses.
It would be rare for us just because of the size of companies we're investing in. Maybe on the higher end, it's possible. At 100 to 400 million enterprise values is what I was referring to earlier.
You ever take anything private?
Yes, we did a go private transaction this year, even with a casino, Affinity Gaming. But again, that's on the larger end of what we own from a size perspective. So that company will do close to 90 million in EBITDA this year, 100 next. So definitely on the larger end of what we do.
Over my career, I've done some of those, but I wanted to dispel an IPO is not really an exit. An IPO is just is a window to an exit. An IPO is ability to get two scripts, cash and stock, and it's the world is littered, as we all know, with companies that have gone public and then it's gone down. We use it. We don't really use it as an exit opportunity. It's usually more of an ability to get a cheaper cost of capital.
I think there's more opportunities for the size of businesses we invest in to go the other way, right? Because there's a number of companies that have no business being public, and for that reason they're not managed appropriately, and they have some costs that they don't need to have as well. So we certainly look at those opportunities often.
Cool.
This is another interesting slide. It shows the PE portfolio company inventory. It's basically rather stable, but you can see the aging of the portfolios, and about 40% of the portfolios are 5 years or greater. So,
is that a change in strategy or just a necessity dictating that people just don't see the exit in 5 years?
I don't think it's that they don't see the exit. I think people would rather invest more dollars behind a management team that has shown that they can really develop a business, and people are willing to hold the businesses longer because it's a management team they know and trust, and they'd rather put more capital behind them versus you take more risk when you buy a new business versus a business you have in hand.
We see a lot of family offices coming in and with sometimes lots of money, and then they always are telling the management team or the owner, particularly, we're holding forever, and we don't have the 5 years strategy. I don't know if that's influencing.
I think it is. I mean, and we have sold businesses to family offices. And family offices, there's been so much wealth created with these wealthy families. They are a viable exit, and they are a good steward for businesses in terms of developing businesses over a 10, 20-year period. So I think it's positive for the U.S. economy overall.
Yeah.
I agree with that. I mean, I think also that, they don't have the issue of the investment horizon that PE firms need to work within to generate the target returns that they do. Typically, if you're going to go say that your target returns are 20% IRRs, well, 3 to 5 years beyond that, it starts to get harder and harder, right? So, I mean, they don't have that issue with the family offices, so then they can manage the businesses for the much longer term as well. I can't see this, but is there also on this chart, does it show the amount of capital or the number of managers?
I've got that coming. I've got a slide coming
Got it.
on the number of funds and the capital under management.
I would assume that it's a similar trajectory, and therefore, if you did it per dollar raised, or if you did it with a something that makes it apples and apples, it won't be as much of an increase.
Yeah, I'll show you the next slide.
I don't think the longer hold periods are there by design. I think they're there by necessity. I don't know, Bill, when the data start from, but I think that portfolios have gotten longer because we ran into the recession. And it means that either funds, and this is from a fund perspective, family offices are obviously different. From a fund perspective, money was not deployed, or money that was deployed before that got locked up a little longer than anyone had intended it to be locked up. And so I think you see the data. I don't think there's many private equity funds that would not covet a faster, quicker a sale than a longer build, even though we can all placate our hold period to say, well, we're building value. I think, we get into deals to get out of deals. And if you can get out quicker, or if you have the elusive IRR, which may be your driver, false as it might be, then you'll get out faster.
It's a little surprising to see this, particularly because it's been such a seller market, and it seems like most private equity firms we've talked to over the last 4 years were selling everything they could sell. They saw it as a good market, and so then to see that, it's doubled really the hold period since 2010 is a little surprising.
Right. I think to Brian's point, there are a lot of businesses that were bought during the recessionary period that it's been a challenge to grow the businesses, and people are holding on, believing that eventually the businesses will grow and they'll find a better exit alternative out there.
John, this is where you're looking to play.
For sure. One comment is we find a lot of competition from family offices in that lower middle market because they have that longer hold period, and that message resonates really well with a lot of sellers.
If you could plot and I don't know if you have the data, but if you could plot the hold period to the number of extensions of maturity that the debt had, that would be an interesting thing to talk about.
I find the message plays well, but with owners, an extra turn usually ends that conversation.
That's true.
The number of PE firms, rather flat, but what's interesting is if you look at the newer funds that are coming to market, there are fewer under 100 million of total assets, and then the asset class between 500 million and $1 billion and above $1 billion are actually growing. So it's a situation where it's more difficult to be a small fund than it is to be a larger fund.
I mean, you have those behemoths like Blackstone and Carlyle are bigger than ever.
But those are different businesses. I mean, all of us there's various sizes of funds represented on this panel, and certainly when we talk about numbers, it's an aggregation of X number of funds. But KKR and the other, they're in a different business. I mean, we all say we're in private equity, but trust me, we're not running into those guys whatsoever. So there are, again, as you've gotten people that have got billions and billions, they're putting more money in deals than we manage in total. I mean, it's a completely different business.
It's got to be hard, John. You guys have to have so many deals to fill up that billion, the pipeline.
Well, we certainly will look at. We had our meeting yesterday. We probably walked through 50 deal opportunities, and we might pursue 2 of them, and we'd be happy if we closed one of them. But Brian's point, the big firms, be it Blackstone, they're asset accumulators. The more assets they accumulate, the bigger the fee income. They can monetize that fee income in a variety of different ways. We're really working for the capital gains in terms of really transforming underlying businesses so that we can record a good return on our capital. We don't focus on the IRR. We focus on multiple of our capital.
I would also add, it's not a number of deals, right? no matter what, it's a concentrated strategy. You're not going to get a tremendous amount of diversification just in one fund. With the size of companies we invest in, it's usually going to be a $50 to $100 million equity check. So for $1 billion fund, it's not a lot of companies, right? But nonetheless, I mean, I think the businesses, I agree, are tremendously different for us versus larger firms.
Okay, assets under management, 1.465 trillion, a little bit higher, but relatively flat. It's a lot of money.
It is, but I think the pension funds and the other organizations that are trying to invest capital, the alternative investment arena offers better returns than the public markets. And so they're almost, just given the nature where a lot of pension funds are and how low interest rates are, they're forced to put a bigger allocation into the alternative class.
Well, the other thing that it's an interesting shift that's gone on. I remember, I don't know, about 10, 12 years ago, we were raising a fund, and at that time, our competition for the LPs were hedge funds. And even at that, the terms and conditions of a hedge fund had a 2-year lockup. We would come to the market, people, even institutional people, oh my God, you guys want a 10-year lockup. There's some shift that's also gone on that I think, as we all know, hedge funds have gone down and they moved into the private equity investment arena. Then we're just buying stocks and bonds any longer. And so it's a better time to be a private equity fundraiser than it is to be a hedge fundraiser right now, particularly if you're going to private deals.
Brian, how large is the secondary market for PE fund investments? So if you wanted to...
It's getting larger. You mean if we wanted to sell off you mean to other private equity, or take our fund and sell...
No. If you were an investor and you wanted to liquidate your holdings in ABC fund,
yeah,
there's a secondary market
There's
out there.
a growing secondary market, and,
right,
and people are realizing, and as it's grown, I've also seen the discounts coming down from what those people have to sell from. But there's again, the evolution of this business. Now there's secondary, maybe there's tertiary markets, I don't know, but it's getting larger and larger, more liquidity.
And also, people like to invest in fund of funds because then they're spreading their risks among various funds. Although there's a cost to doing that, but
sure,
people are doing that.
I have a quick question. Is that money that was invested at the time, or is that adjusted as the values are going up, hopefully?
No, that's the current amount that's invested.
Invested.
That's so reported, yes.
Not reevaluated for what the values are today, hopefully. Thank you. You're welcome.
And then fundraising by fund size. And you can see that we're off to a pretty good start in 2017.
Let's hope that continues.
Excellent.
That's my last slide.
Great job, Bill.
Thank you.
Just before we get, we were talking this morning, and you said that things are really pretty busy right now.
Yes.
Can you kind of tell us what you're kind of seeing?
We have a better insight now into the market because we're doing more sell-side work. I would say about 50% of the work we're doing now is sell-side quality of earnings, and there's a nice group of companies coming to market right now. Some are, divisions of public companies or divisions of situation where a client was in bankruptcy, they emerged from bankruptcy, and they're selling off a couple of their divisions. So we're seeing that. We're seeing, family-owned companies coming to market, and we're doing quality of earnings for those companies as well as advising them on tax and other matters. We're seeing family offices being very active. It's kind of interesting. If you've got wealth, and we've seen groups of families come together to form kind of a group of family offices. So we're seeing that. I met with 3 guys, and they were considering forming a private equity fund. I said, guys, why do you want to form a private equity fund? You got enough wealth here. You don't need to really manage other people's wealth. You could just manage your own wealth, and that's actually what they're doing. And then I think, we don't have, I don't know if there's any investment bankers in the room besides Tom here, but the investment bankers here are doing an excellent job on the auction process, and they're not granting exclusivity as fast. So we could do a sell-side quality of earnings, and we could have up to 10 potential buyer calls prior to signing an LOI. And some of the companies and buyers are trying to position themselves to get preferences to do due diligence, either kind of a high level, or some are doing extensive due diligence. And it's kind of interesting how they position themselves with the seller and the investment bankers to try to expedite the process and close on an accelerated basis.
Absolutely.
And you're also seeing, I guess, as we saw earlier, very high multiples. So it's kind of interesting. And you're seeing a lot of rep and warranty insurance, where the buyers are using rep and warranty insurance.
I think the nature of the whole deal process has changed. In terms of 5 years ago, you rarely saw the seller QOV, rep and warranty insurance, and you usually got exclusivity. Now it's just such a hyper-competitive market for these auction situations that it makes it very difficult for the private equity industry because you have to spend a lot of dollars taking, risk dollars that you might spend on other opportunities in that process. Rep and warranty insurance we basically see on every deal right now, and the investment bankers sort of mandate that's part of the deal.
How low, now, the problem with that before was it was just the premiums are too expensive. It makes a lot of sense, but how low has that come down and people see?
Well, the premiums are affordable. Collecting is another matter when you have a claim. I mean, trust me, it's not. They just don't pay these claims off. They fight you tooth and nail, and you spend more money on lawyers trying to collect the claims. So they're not the panacea that people think they are.
If you do a great job of due diligence and you identify a risk, that risk is excluded from the rep and warranty insurance. It's just things that you haven't identified. So if there's a tax exposure and it's identified, and you have rep and warranty insurance, it doesn't cover that exposure.
Actually, I find it to be pretty expensive, and I also have found that the underwriting process is difficult. So those insurers that are writing rep and warranty insurance, it takes a long time. It's hard to do because, I mean, the premiums reflect obviously the times that there's going to be a battle, and nobody wants to just part with cash. But it's now becomes just like QOVs. It's becoming standard operating procedure, and someone's paying for it. But it's hard to underwrite.
John, you want to tell us kind of what you're seeing in deal flow and your outlook right now?
Well, there are a lot of opportunities out there. I think we're seeing more opportunities than we ever had previously. But the valuations have seemed to have gone up a turn, 2 turns, 3 turns for cyclical type businesses, which difficult to comprehend, but I guess that's the market. So plenty of opportunities. It's just hard finding opportunities that really fit from a value standpoint for our business. This leverage is excessive. Leverage still remains the drug of choice for private equity, and the financial engineering. You can justify or rationalize any return.
Do you tend to lever as much as you can, or do you say, you know what, that's going to be risky, even though I could get that, I'm going to kind of bring it back?
We're a little more conservative in terms of, we know we're buying cyclical businesses. I'm not smart enough to determine when it's going to cycle down, but the presumption I make, it'll cycle down under our watch, so we rarely put more than 3 times debt on a business.
Interesting.
I would echo that to some extent. In fact, given where we are in the cycle for the last couple of years, we've been in our investment thesis and new deals, we're factoring in a recession. So we're showing the company, but as a result, as John was saying, it's hard to participate in auctions and win anything. So, it's really about looking for opportunities away from that, and which means that, whether it's thematic investing or whether you're looking at fragmented businesses or at family-owned businesses where there isn't a generational change, a lot of it is more direct. And you have to invest, in the infrastructure accordingly. We have more business development people, more operating partners, more investment team members actually focused. There's a certain amount of time that they're dedicating specifically to looking for deals, where previously, that ebbs and flows, obviously. Mm-hmm. But in these cycles, this time of the cycle, you have to spend much more time looking for those.
But leverage buyouts are decision by committees. You have a lot of constituents that come together, shockingly, when a deal closes. You've got the management team that generally is asked to or required to invest. You've got the equity buyer who is obviously putting in a certain amount of money, a growing amount, a percentage of the capital structure. Oftentimes you have a mezzanine player, and now you've got senior lenders. So there's not any one constituent that's driving what we're talking about is higher multiples or overvaluation. So the real question is, are all 4 or 5 of these constituents all wrong? Or is anybody just driving this up? And does anybody come to the closing saying, wow, I just overpaid, congratulations to me? Everybody is looking at this thing with some theme behind them, some thesis behind their investment and what they're doing. And so, so multiples, are higher. Maybe it's not on a relative basis, but deals are getting closed, and there's no one that's not protecting their capital and looking at it. So I'm not sure that anything is being irrational. If I look out there and take a look at if I look at metrics, which I don't follow statistically, but it's just an anecdotal view of what's going on. Sure, I see that multiples are higher. I'm not sure that necessarily means that my deals will be bad or that it's overall a bad thing. You'll see only on exit. What I am seeing, though, is that there's a tremendous number of venture-like deals. I'm not talking about ideas and stars. I'm talking about some things have been going on for a little while, and now people feel they can underwrite revenue and underwrite future earnings. And so if you went to my office, the floor would be littered with high growth stage venture-like deals. And I think that signals something in the market that people are now moving for return envy and trying to find something that they think I've got a niche that I'm going to go and see it grow.
Raul, do you want to tell us kind of what you're seeing in the market?
Well, I know many of the folks here know us from 10, 15 years ago, where we were doing exclusively distressed transactions. But things we've evolved, as I mentioned earlier, to doing many other kinds of deals as well, and this year reflects that. Given the cycle, none of the deals we invested in this year were distressed. We had a one go private transaction, one corporate carve-out, one, not a distressed deal, but a deal that had already restructured and owned by lenders, and we acquired it from them, so it was a little bit undermanaged. And then several tack-on acquisitions to our existing portfolio companies where there are synergies. So it's, we're trying to find situations, much like Brian is mentioning, where we feel we can add value that is sort of off the run, if you will, out of auction processes and more direct. And we're having some success, but it's never as much as we would like.
John, what about you?
Yeah, same as Raul. Most of our focused effort is around thematic sourcing or special situations, trying to resonate an operating partner with a founder or a CEO of a business, and be really scrappy about it. And we'll participate in auctions, but it's not the preferred route for us today.
I'll give you an example. We closed a corporate carve-out early in the year, and one of the competitive advantages, frankly, was that there would not be a transition support agreement. So, with the seller, so we had to be ready with an HR function, IT, everything that was corporate services before day one, and make sure that was going to work swimmingly and nothing was going to break. So we did that. It worked great, but those are the types of things you have to sort of differentiate yourself by in these types of environments.
Brian?
What's the question?
What's your outlook as far as deal volume and outlook?
Oh, I don't know. If I have no idea, I think that as I said,
that's the first time you ever said that.
Yeah, well, I don't know exactly. No, I think that I think that I sat here last year, and Tom asked me to be on the thing, and I thought that there were a lot of the drum beats of bad economic opportunities. I think that that we all know that at some point the downturn will come, and people will then shift the type of deals that they're doing. We're in this kind of market right now, and people do a certain type of deal. When we get to this market, it'll be in this market, a different. There are always deals. Things will always change hands because there is a lot of capital out there, and all of us in the room get up every day trying to figure out how we can either advise on surface or close the next deal. So I think there's always been a better return on capital, return on labor, so people are doing it. As the cycles go, the types of deals come, but people keep doing deals.
You know, at Ravinia, I mean, we're growing a lot, but I think the overall market, particularly, we focus a lot on middle market family business selling like 50 to 500 million. We're seeing an equal amount of healthy deals and distress, but the distress market, I still think, shows spurts of kind of picking up, but then it just really isn't there because there's just so much capital available. But we're finding when we have a company to sell, the hard part is getting the companies to sell. Once we have them, then we know we're going to be successful. It's just how successful, and we're finding, you guys aren't going to like this, but like that it works best we go to like 1,000 buyers, and we find that we'll try to create competition on the tail end. Somebody that's got their own thesis of it, and we just sold like Rex Electric. We sold it to an Alaskan Eskimo native fund that we just happened to find because they owned a contractor in Hawaii, and they were in the process, and they ended up being the best bidder. But not sure where I'm going with this.
But I think, Tom, you hit on something that is interesting. It's the notion of distressed deals.
Thank you.
In September of 2017, if you have a distressed deal, the distress is probably pretty bad. If you were dealing in 2009, it may be stressed, but not distressed. I mean, and so that's exactly the point as we talk about what is the outlook. It's using distressed deals as right now. If you're dealing with some distress, it's probably got operational problems. It's got something really big.
Right. Well, we see a lot of and there's Daniel from Hillco. Like our competition, a lot of times is that they're thinking of liquidating, and that's the easiest way. And like we can come in and show the value, and so that's kind of. You're right. It's very, but we like it too because it's like they'll be like panicking, like we can't make payroll, and we're like, well, that's going to help our award application.
That's distressed.
But you said something. You had a Alaskan Eskimo tribe buying a contractor in Hawaii. Tells you how screwed up the market is. Really. I mean, it really.
Yeah, you're right. You're right. Well, I just want Bill.
We haven't touched on a couple of things. One is. One of the things I've noted was number of energy transactions are down. Yeah. And I'm not sure what the Houston hurricane will do to energy, but we've clearly seen prices increasing at the pump. The death of the border tax, I mean, the border tax would have been terrible to retail, right? I mean, if you had to pay a tax on top of importing your goods, so if you were Walmart or Target and you imported your goods into the U.S., you'd be paying a tax on top of that, not based on income, just based upon the purchase of the materials or the purchase of the goods. So that's kind of died. You've got potentially a reduction in the corporate income tax, which I think would be great for PE firms because they would retain more cash and pay less in tax on the C corps that they own. So that would be great.
But I think Bill is raising a point. A lot of this stuff revolves around, I don't want to say it's a dysfunctional federal government, but it's a government that seems to be in disarray from a policy legislation standpoint. They're just having trouble getting their footing and setting priorities from a policy standpoint, which creates caution and murkiness as to where this all will go. And you still got a federal debt that is, it has to be dealt with at some point. And if not, you are going to see a contraction.
Cohn and Mnuchin now are on deck, so it's going to be interesting this fall to see how those Goldman Sachs bankers do in Washington.
I think it's positive. There's some adults in the room. So.
Yeah.
Right. The minimum wage, the increase in the minimum wage could have an impact. And then the impact of Amazon on retail. I mean, there's some retailers out there that are somewhat distressed. And, and then the suppliers into those retailers and whether they're going to collect their receivables. So there's a lot of issues that
I've never seen companies, and you got complain as much about the difficulty of getting labor and how just getting people to show up and pass a drug test.
I will tell you, we have a business down in Georgia. We set up a bunch of new plants, and we probably we hired 300 people. We had to go through about 1,000 people to find 300 who weren't addicted to coke or meth. I mean, it was just impossible finding labor.
Unbelievable. I'm going to just have one last question, then we'll go to and then we're going to start the next panel. But this is going to be a little, I was just thinking about, how you guys have such history and success, but like, if there's one kind of lesson you've learned from you started that you really didn't know then, but you know now when you're thinking about doing deals, it's, what's something that you've learned over the years that's really now kind of critical to your success that you didn't kind of realize? Tough question.
Two things that I think really matter in terms of buy a business that's well positioned. A lot of businesses say they're well positioned, but they really don't have underlying franchise value. And then the most important critical elements, invest with honest people who can run businesses. If you have people that aren't totally forthright and honest, you will get burnt. We've been burnt several times by just hiring the wrong people.
Those are good pieces.
I would say because we're not a volume shop, and a lot of people say, "Well, I bet the jockey." I found that it's important to bet the horse and the jockey, and if you really don't have a good horse, to John's point, fundamentally strong business that knows its ethos and where it goes. It doesn't have to be everywhere. It's really hard even for the jockey to move the horse. So I look at the horse as much as the jockey, and it's very hard to turn the ship if you have to. So why not? You don't have to do every deal. Find both of them.
I echo your sentiment. I would just say discipline, especially in the market that we're in, is be very disciplined.
I think everybody touched on it to some extent from a human capital perspective. If 15, 20 years ago, certainly everybody, even then you felt that you had to make the right people decisions, but the importance of making them right and making them quick is really important, especially given our investment horizon, because 6 months or a year lost is a long time within the investment horizon. But also the culture of the organizations. If you have a cultural problem, it's going to take a long time for you to fix it. It's not just changing the people at the top, it's everybody. And we try to have what we call a C Capital University for folks to come in when they join the organization to say, this is the way we look at things, this is the culture we expect you to instill in the organization if it doesn't already exist. And all the common sense things like database decision making, ROI thinking, all of those things. It's surprising how many times we see that as not being existent at these companies. But that's part of the opportunity. But, you can get really behind if you don't identify those issues and deal with them quickly.
Yeah. I'd say we also, one thing is that I've learned to focus a lot more on earn-out provisions, being very cautious. If you're selling, once you lose the control, you've got to get things very objective. Also, really focusing on learning more and more about things like working capital adjustments, because those often get not thought about, and they can have a huge sway in the price. We're working, Bill, on a thing with you guys with
right.
Yeah. One question, then I'm going to turn over to the lender panel, and this has been awesome. Thank you.
Hi. My question is about interest rates. What would happen to the deal market if over 18 to 24 months interest rates doubled? So just across the board, they just doubled in, let's say, an 18-month period. What would happen to the deal market?
Well, I think the biggest problem if interest rates go up, it's going to have an effect on real estate even more than the deal market. So if you have underlying collateral that's real estate, it's going to be somewhat of a problem. But I really believe that within the deal market, Keith, what will happen is you'll get into a lot of extending in negotiations with the lenders. Eventually, I don't think that the interest rates will actually kill the companies unless it's completely interest rate sensitive business. It's just another restructure, and it kind of water finds its level eventually.
I would say also, the businesses that we invest in generally have floating rate based debt, but they also have LIBOR floors. And so if you're doubling, you're starting off a pretty low rate. It's unless credit spreads are double with the floating rates, it's not going to have a measurable impact on from a pressure perspective. But an extension of what John was saying earlier from a leverage perspective in the system, we were talking about the government, but consumer credit is at an all-time high as well. And how that impacts the consumer and then in turn the buying power that impacts our companies, that might be more of the impact than just the interest expense on the company.
I'm going to end with one, is to say I think that the market right now, it's going to be kind of more of the same. It's still a seller's market, lots of capital. We're going to see this for a while until we don't. And it's going to change suddenly. It could be in 2 weeks. It could be in 5 years. I would recommend everybody, if they haven't seen it, watch The Big Short. I think that, we're kind of, everything's going to be fine and everything keeps going like this. And then it's going to, all of a sudden things will reverse. The stock market will be a big indicator. It could be something with North Korea. It could be just a rumor like the flash crash, or it could be nothing for a long time. But at some point, gravity will take hold and things will kind of come back to this way, and maybe ultimately, and it's going to happen really fast. And then everybody say, "Oh, I saw it coming." So, thank you, panel. This has been outstanding.
Thank you.
We're going to move right to the next panel. Before we do that, though, I want to also thank all the Ravinia Capital team for all their hard work in putting this together. And I want to particularly acknowledge and thank Eric Welshko, who you might have seen in Cranes this week, has been recently became a partner at Ravinia Capital. And also, we'll be going to New York in a couple of weeks, as Eric has been named M&A Advisor 40 Under 40. We're receiving the award at a black tie event, and we're very proud and excited for Eric. Eric has been beyond what I could have dreamed about as far as having a partner and somebody to work on deals together, grow in a company, and just very proud of him and looking forward to hearing his panel.
Thank you, Tom. Much appreciated. I want to point out, too, and I guess reciprocate a little bit, but look, this is a really special event. This has been going on for several years. And Tom, you've done a great job of pulling together outstanding panelists consistently. And then also, we have an excellent audience. I mean, I think we had 250 people sign up for this event. I looked through the list yesterday. It's all top transaction professionals. So many thanks to all in attendance, and thanks for Tom for pulling it together. I've been in an interesting kind of position over the past couple of years at Ravinia to study, the middle market transactions and gain an interesting perspective. And in that role, I've been very involved in the Commercial Finance Association, and just seeing kind of deals get done, I've got to see a lot of different approaches and meet lenders across the country. I think one thing that I've noticed is that the innovators and a lot of the industry legends seem to be kind of focused around the Chicago market when it comes to some of the best lenders that are out there. And I think today I'm very excited about this panel that we have, in that you have some of the top dogs here in the Midwest. So from one of the best markets, we have some of the best participants. So I'll challenge, at least hope to challenge the panel here today to provide your insights and give us your general thoughts about what you're seeing in the markets. And we'll open up at the end. We'll try to leave about 10 minutes for Q&A from the crowd. And hopefully we all learned something here today. So we'll start off with introductions. If I could have each of you kind of walk through and talk through, first of all, who are you and how'd you get to where you're at, but also talk about your company and your institution, and tell us, where you kind of fit in the market. So, Bob?
Well, thanks, Eric. Thanks for having me on the panel. My name is Bob Shanahan. I manage the asset-based lending group of Wintrust. My background was through American National Bank, Bank One, eventually Chase, and then I started up with Wintrust 13 years ago. We run an asset-based group, over $1 billion of commitments. We operate primarily in the Midwest, but we scatter throughout the country depending on where our customers go. And we are very active not only with third-party intermediaries, but also our own commercial banking staff, where we source much of our business with the 80, 90 commercial lenders very active in the Chicago area.
John?
Hi, my name is John Todd. I'm with Allostar Capital Finance. I've been in lending for a little over 20 years. Started my career at Congress Financial. Spent time at Foothill Capital, Bank One, J.P. Morgan, and Capital Source before arriving at Allostar in 2011 when we were founded. So we're a little unique. We were founded on the heels of the credit crisis, where we took over a failed institution, had a loss share agreement in place. We were really after the cheap cost of capital with the internet banking platform. The business plan was to provide asset-based loans and lender finance to the lower middle market community. Deal size we quantify as $5 million to $60 million in general. And where we really try to position ourselves is we want to be that first call when the money center banks can't do a deal because there's too much customer concentration, there's too big of a term loan, there's some bend in the deal, it's, whether it's the recent financial performance, something in the deal that would give lenders like that pause. So with our bank cost of funds, luckily it affords us cheaper cost of capital than the finance company, so we fit really well in that market. We've recently announced that we're merging with State Bank and Trust out of Atlanta, which is literally their headquarters are just down the street from us. And the nice thing about that is there's virtually no product overlap. They're largely Georgia-centric with their investing, where we're national. So we're excited for that transaction to close, which publicly announced is targeted for Q4 of this year. So, and Eric, I'm honored to be on this panel with guys here who I think are icons in the industry. I see president, business head, and well, I had the Midwest region for Allostar. So,
we're happy to have you on. Thanks.
Bruce? Thanks for having us all. Bruce Demby from the private bank. My career is really exciting. I've worked in 2 buildings my entire career. So started with LaSalle, was there for about 30 years, and then a brief stint, or not quite 30, 20-some years, and brief stint with Bank of America, and now with the private bank, which we founded the asset-based lending group with Bob Corsentino in 2009, which I heard him talking on the earlier panel about 2009. I wish it was back. Careful what you wish for, but it was a lot easier to lend in those days. We've got a very senior team at the group, so while Bob and I head the group up, they make their own decisions. So we've got a national group. We've got transactions in about 30 different states, solidly middle market, $5 million and up. Average size commitments about $16 million. Of recent note, we were acquired by CIBC in June. It's a great opportunity for us because they were not in the U.S. market, so they're going to give us some growth capital, some additional capital markets products, and some more cross-border opportunity, as well as leaving the decisioning here in Chicago. So it's a great opportunity for us, and we're pretty excited about it. So,
excellent. Ted, tell us a little bit about yourself and Monroe.
Good morning, everyone. Ted Koenig, Monroe Capital. I've got the unique attribute here of not being a bank. We're an independent finance business, an asset management firm. We've been doing this now about 17 years. We manage about $5 billion today. We've got about 260 companies in our portfolio, 8 offices throughout the U.S., and we do primarily transaction finance, buyouts, recaps, dividends, growth capital, shareholder redemptions, minority owner buyouts, whatever it is that's a transaction, usually cash flow based, enterprise value based, a little bit of asset based, but we can't compete more with the funding costs of the banks on the asset based lending side. Where we do asset based lending is primarily today in the retail business area because that's an out of favor industry with most regulated financial institutions. And it's been great. I mean, I started off in the community like all of you. I was a service guy. I was a lawyer, billing hours for about 14 years. And then my choice was either jumping out of a window or getting into an entrepreneurial business. And I got into this around 2000 and raised a small fund, about $35 million with some friends at Hilco. And we went to Bruce's bank at the time, LaSalle Bank, and I didn't want to say we had a $35 million fund because nobody would take us seriously. So I asked Norm Bobbins if he'd give us $66 million loan against a $35 million fund so I could say we had over $100 million of capital. And Norm gave us the loan to match up with the limited partner capital we started so I could say we had a $100 million fund. And we started that in 2000. And today, we just finished last year in 2016 our 15th fundraise. We raised $800 million in that fund. And we're in the process now of doing our 2017 fund. We've got an $800 million target. We've got about a $1 billion hard cap. And I think we'll hit our hard cap here in the next few weeks. So we're mostly private funds. Each fund has about 7 to 10 year life, and we have a public vehicle too, which is a company called Monroe Capital Corporation. It's a business development company, which means it's like a REIT. The entity pays no tax. Everything flows through. And we've been public now for 5 years, and we've had 20 consecutive quarters dividends paid, and we pay about a 10% dividend. So that's pretty good. So that's our business.
Excellent. Excellent. This is, we want to keep this somewhat conversational here today. So, Bob, we're going to kick it off with you with a softball question, which is, and we'll kind of go through the whole panel here and hopefully get going back and forth, so we're not going to depend on these slides. What are you seeing in the market? What's top of mind for you?
Well, it was interesting watching the previous panel. It kind of displays what we're seeing right now. Bruce had indicated 2009, 2010, that was a time to be a banker because the opportunities we saw, the competition we didn't experience, created a great environment. I started this business with Jack Myers 9 years ago. Started from scratch, and we went to market, and it was a relatively easy process. As we go today, the competition is fierce. The transactions we're seeing, the requirements, talk about it's a seller's market on the PE side. It's a borrower's market today. I was on a call this week where the distressed borrower was dictating terms to us. We're going to pay legal fees. The bank's going to pay field audit and appraisal.
They were distressed.
They're distressed. Oh, and by the way, we went to LIBOR plus 200, and it was if it were the bank of Bob, I would have said kiss my backside. But problem is, as much like the PE guys, we've got a lot of money to deploy. Mm-hmm. And so, we're the decisions being made in today's market are quite a bit different than 5-6 years ago. And so the incremental transaction that we're seeing today is gosh darn it, it's going to the closing dinners just isn't as much fun as it used to be.
Yeah. Yeah. And John, how do you kind of compete in that, or?
It's Bob brought up a good point. I mean, as far as what we're seeing in the market, it's a supply and demand imbalance. We're seeing things where there's no appraisal requirement in turnaround situations, and you go to these opportunities where they are getting kicked out of their institution, and you'd think that they were a private equity backed, just a perfect company. The way that they get treated, and it's just a function of there's too much capital out there. Yeah. One of the things that we kind of look at is how many proposals we have to issue to fund a deal. And I went back and I looked at some of our statistics, and from 2016 to 2017, it was roughly we had to issue. It was roughly about 23% of the term sheets that we issued ended up turning into funded deals, where now it's down to about 17%. Wow. The good news is we're looking at more deals this year versus last year, but the theme is you got to work twice as hard to get to the same production level.
Yeah. Bruce, was that your deal that Bob was talking about?
No, it wasn't.
So sometimes we're competing on ones that we don't want to compete on. But yeah, no, you really have to love the business today because it's more like a hobby than a career to make money right now. But you find your niches, and I call it being selectively stupid at the right time. Hopefully, on the transactions that are out there, and you got to find the ones that best fit what you're about and have a long-term vision to what it's going to mean. I mean, as Bob mentioned, we actually competed on a transaction. It's a really nice transaction and lots of assets, 16, 17-year history of making money and lost a lot of money the last year and a half. Haven't quite got it fixed yet, and used to paying a very low rate, and so we probably went in at a lower rate than we wanted to get the business, but there was some good wealth management attached to it. There's some good foreign exchange, a good opportunity to be there for a customer at the right time and keep them for a longer period of time. So it's those types of transactions you have to look at and say, okay, this really does fit our model and what we're trying to do out there. But as John said, you're bidding on a lot more. You've got to get a lot more looks. You try to mix in some of those early stage turns with sort of the easier vanilla business that you got 9 proposals on to try to make that yield work. So it's really a lot more recipe driven right now.
Right. Ted, you were kind of an innovator at Monroe, but do you have more competition today as well? I mean, the banks are seeing it, but are you also seeing it from the other non-lenders that have kind of emerged?
Yeah, I think there's competition everywhere. I mean, we were lucky. We had a lot of wind at our backs coming out of the recession. And in our business, we were not regulated. So as long as we didn't blow ourselves up with bad credit decisions, we could grow, and we have quite a bit. And we've been lucky on the credit side that we've got a pretty good team. But what's interesting today is as you just said, you really have to find your niche. There's money everywhere. I mean, the public BDC market is crazy. There's 53 public BDCs. There's probably another 30 non-traded BDCs. There's new funds. I counted 18 new competitors in our business in the last 18 months or so, 2 years. So there's a lot of capital. Capital's not the driving factor right now. It's really relationships. In our business on the deal side, on the bank side, it's a little different because it's a lot of commodity type business, and that's the key in any of our businesses, and I guess your businesses as well. I think you have to sell not only against your competitors, but against the commoditization of what you're doing. Unfortunately, financing has become a commoditized business, whether you're in the bank side or you're in the fund side or anywhere else. And if you reduce it to that level, it's always going to be about rate and covenants and about leverage. The guy that brings the most dollars wins. And what we've tried to do at Monroe over the years is decommoditize what would otherwise be a kind of a commoditized industry. Mm-hmm. And what we try to do is be a little more flexible on terms, covenants, amortization, CapEx, the ability to grow. We've been lucky in that we haven't been capital constrained, so we can offer companies delayed draw term loans. We can offer companies uncommitted acquisition facilities. We can do lots of things to kind of help a PE firm or a family business grow and have a flexible capital stack. That said, about 4 or 5 years ago, I think I was here and I told everybody that the banks were in trouble, and they were not really going to be able to compete in some of the transactional part of the business. And I think that the things are changing a little bit. I think the banks are coming back, and I think Bruce talked about it best. Is that when you think about a bank, we all think about, well, how much can I borrow and what's the rate? That's not the game for banks. Banks, it's kind of a total product return, and that very often is your checking account, your wealth management, your mortgages, all the other stuff, payroll accounts, operating accounts. So when Bruce gives you a rate of L200 and Bob gives you a rate of L185, that's because they're counting how much money they make on all the other stuff. So if you look at over the last couple of years, the banks have been really great places to invest. you know, what First Merit sold at, you know, 2.3 times book, or, you know, it was great. That's heroic. What these guys sold at recently, you know, close to 2.5 times book, heroic numbers. You know, Bob's Bank's next. Wintrust will get sold at 2.6 times book.
Wow, you heard it here first.
Not yet, Jack.
But those are all good things. So the markets, I think, the financing market is coming to appreciate, you know, the value that the banks play.
Well, that's a good feel-good moment for me to bring a headwind in. So we talked on the call a little bit, preparing for this, about regulation, and has that really come into a play? I think, Ted, on the panel you spoke on a few years ago, that was one of the topics, and it still is today. So what are your thoughts around that?
So we had talked in our pre-call, one of the items facing commercial banks, and then specifically relative to the asset-based function, they've put regulations on the leverage 3-4 times, and there's different hurdles and et cetera, but for an asset-based situation, those rules don't apply. So actually the legislation, those regulations have helped the standard asset-based lender within a bank compete on some of those transactions. When somebody says, geez, that deal is really leveraged, it's 4 times, 5 times, 6 times, sometimes I don't care. It doesn't make a difference in a commodity distribution business that they're 8 times leveraged, because it's not an applicable measurement. But it gives us the ability to compete in some situations, and an advantage in some situations that the regular conventional lender can't compete with.
I think the regulatory environment, it is evolving. I remember back in the day when Bob and I were both at Bank One, and everyone was so concerned about risk of default as opposed to loss giving default. And I think it's coming around a bit with the ABL community and in the banking environment, where they're recognizing that there is a difference, especially if you're well collateralized in a transaction.
Yeah, I think that one of the things that happens with it's a two-edged sword, right? It hurts the banks from the standpoint of the regulatory, you know, scrutiny that we undergo day in and day out. As Bob pointed out, in the ABL world, we get some advantages from it. I mean, we see it in our shop from a standpoint of sort of an uptick from something that would be otherwise criticized, but because the company has the liquidity to finance the cash burn over the period of time that we see it emerging from that burn, you know, we don't have to put that into our criticized bucket, which, you know, banks as a whole have gotten a lot more sensitive about sort of what's in their criticized bucket. I mean, I remember the days in LaSalle, we talk about it, but it wasn't a big issue, and now there's a lot more scrutiny around it, and I think that's because we got to such a low level of criticized assets in the portfolio that people don't want to see it increase, and naturally it's going to increase over time. But so that draws a few more credits to the asset-based world that might otherwise go someplace else. And I know with CIBC, they look at our business even probably better than the private bank does, in the sense that, you know, we get that extra credit for the loss given default and the fact that you've got so little in write-offs. So that helps from a standpoint of return as well.
Yeah, we don't really deal with the regulatory issues as much from you know, because we don't have the examiners in our offices. You know, for us it's like a baseball game though. You know, every inning the score goes up, and unless your score's good, you're not going to be able to raise money. So, you know, for us, we've kind of been living under this kind of baseball for the last 17 years, where every quarter your returns have to be good, and losses, you know, hurt your returns. So there's lots of lenders in our business that aren't as active today as they were 5 years ago, or that aren't as productive because of losses. So whether it's regulated or non-regulated, you know, losses hurt us first, because, you know, we get compensated based on management fees, and we have preferred returns to our limited partners in all of our funds. So, you know, we're the ones that are eating the first loss. So we're very focused on making sure that that doesn't happen.
And that was even more so important, Ted, when a lot of the competitive firms of yours fell below $1 in par value, and their ability to raise capital really was impacted.
Yeah, it's you know, it's an interesting business. I mean, if you, like anything else, whether you're regulated or non-regulated, you know, if you lose money, you're going to ultimately blow up your platform. So the key is to control your losses, and we just have to do it internally, and that's part of the benefit that the banks have is they've got some outside discipline and there's some consistency. In our industry, you can look at, and again, it's crazy. There's 53 public BDCs. Probably 10% of those have performed well over the last 3 to 5 years, and the rest of them, in various degrees, have not performed very well. And the public numbers are just a precursor to a lot of the private funds too. So.
Well, that could bring us back to the acquisition point that we kind of touched on, but maybe let's sit there for just a minute. And Ted, maybe you can talk a little bit, on the non-regulated lenders that you're speaking of. Is there room for a potential consolidation strategy there, or does that not work?
There is room for consolidation strategy. The challenge is executing on that is very hard. Many of the platforms are independently managed, and they generate management fees, and the managers are very reluctant to give up that stream of management fees. So you can't really do a hostile deal. Most all the deals in our industry are all consensual, because the public companies are held mostly in retail hands, not institutional hands, which means they're very widely held. So to get anything accomplished, any vote, is virtually impossible. Even if it's a bad manager. There's a couple of, what I consider to be kind of subpar managers that have really taken some big hits over the last year or so in their stock. They're trading at 60, 70% of NAV. And even them, it's hard to dislodge the managers. What's happening, though, that I think you'll continue to see is you'll see regulated financial institutions as soon as the government changes some of the laws, try to acquire some of the non-regulated guys, because we've been able to build up a decent market share in a space, and what you're seeing now is insurance companies and other large asset managers consolidate there. So there's a big push now with a lot of the insurance companies, and we talked earlier. I was talking to Penny. I don't know if she's still here, but Allstate just backed a deal with CIT. And you take two kind of semi-regulated businesses and kind of create a joint venture, and poof, they're non-regulated now in the joint venture. And I've gotten a lot of calls from insurance companies that want to come up with some creative strategies to do some things to invest assets. So I think that if you're forward thinking, and there's going to be some really cool opportunities in the financial services spaces to team up with either regulated organizations, either banks or insurance companies, or a lot of European and Asian asset managers want to crack into the U.S. as well. They're going to look to try and get a beachhead in the finance business.
Yeah, that's a great point. I mean, I mentioned before that we try to take a small piece of our portfolio and do those early stage turnarounds, and you think about, at least the older guys that have been around in ABL a long time, the way we built our business over time was to take that transaction that was sort of, not desired by a lot of people, had a lot of assets, we knew we weren't going to get hurt even if they didn't turn it around, and bring it in at the right time, and then you had a customer for life. I mean, that's really how we built our business at LaSalle. And now with this sort of emphasis from the regulators and the emphasis from the banks on sort of keeping that criticized bucket down, it's tougher to get that entry-level credit in the door. You've got to wait till there's sort of a substantiated turnaround. And, you see the finance companies popping up. There's plenty of business for them out there, and we're supposedly not even in a bad economy yet, right? So the reality is it's probably only going to grow, and, that's great feedstock, but if you've got to sit on the sidelines and wait till everybody else can do the deal, it doesn't help you any. So I think Ted's point's really good, that I think there will be, if the regulations ease up just a little bit, you'll see some consolidation along those lines.
I guess if you look at the regulation side, you've got 2 out of the 3 bankers up here that have either recently gone through a merger or are going through a merger. And, I think that that's probably going to continue. I look at my career, in every institution, whether it be finance company or bank, has been bought and or sold, either while I was there or shortly thereafter. So I think the trend continues. I also think that you're going to see, there's different levels of regulatory reporting and burden at certain asset size. I know 50 billion is a big one. I think 10 might be another one. And so if you're going to be a $9 billion bank, you might as well be a $40 billion bank. No one wants to rub up or just cross that threshold. They want to blow right through it so that they've got the critical mass to cover those added regulatory expenses.
To that point, I was at a client a few weeks ago, and this is a good plug for Private Bank, and that a $5 billion bank tried selling my client that, well, we're never going to be bought like Private Bank was. And my client turned around and said, well, actually, that could be really helpful for us because now there's new opportunities for us. So that, to your point, there's some strengths, even though some of the $5 billion banks might say, hey, this is not necessarily the best thing. It really does have some positives behind it.
Other than having to learn to speak Canadian. But.
Yeah. How's that coming along?
8 years.
And Wintrust, I mean, you guys have a great market here in the Chicago area, right? And
knock on wood.
So do you continue to grow, and do you grow into other regions, or how do you focus that?
Well, that would, if Ed Waymer were here, he could probably answer that a little bit better. But the reality to it is, one thing we haven't done is made any blockbuster acquisitions. It's piecing together, growing organically, buying 300, 500, $600 million institutions, plug them in, really building the retail network, which is real important to us from a funding standpoint, and then basically growing our commercial side organically. And that has worked up to now. The concept we were joking around about which banks would have made good fits, which wouldn't have, and I look at it from a commercial standpoint. Culturally, it'd be interesting for us to do a blockbuster move. Just trying to put, if we had put together Private Bank and Wintrust, the bankers that have known each other for the last 20 or 30 years, it would, we'd had, a brawl in the lobby or something. I mean, it's, it's the old American National Bank and the old LaSalle Bank, but. We have grown, again, organically, and we don't envision any large moves. I can't imagine that even a regional move would be forthcoming. Trying to expanding. I think we have 20-plus locations up in Wisconsin, making a move in northwest Indiana, and trying to spread out, instead of, there was a term of, 300 miles from the Willis Tower kind of by footprint. We're moving beyond that. We have several businesses that are national businesses, whether it be a leasing business or a mortgage business. We have a subsidiary called FIFCO, which is insurance premium funding group that is a national business. So we're seeing a little expansion, but for the most part, sticking to the Midwest.
There's a question for the panel. We were talking earlier about the transactional nature of some of the people that are winning on the different deals that are getting done. What is, in your opinion, what is relationship banking, and does it still exist today?
Well, Bruce had touched upon it earlier, the concept of picking our fights, trying to work with those who we know, who we have, it's a good fit institutionally, et cetera. That gets to the relationship banking. And that part was the mainstay of the old LaSalle Bank, the old American National Bank, was the concept of he's a good guy, she's a good lady kind of concept resonated throughout the institution. When American National Bank won Chase, and there was a time when I was looking at a deal at Chase, and I said, well, he's a really good guy, and they made fun of me. I go, Bob, is that guy a really good guy too? And so it wasn't, no longer was it a relationship, it was put it down on paper, otherwise it doesn't work.
Yeah.
And so now you got the institutions represented here where he's a good guy, she's a good lady, kind of resonates again. And relationship banking is back in vogue, where again, from some of the larger institutions, they literally would, give it to the relationship banking guy. It was kind of funny.
Yeah, it's a powerful Midwestern term, right?
Yeah.
So, any thoughts about that?
For us, historically we started off as more of a transactional related asset-based lender, but over time we realized it's so expensive to onboard a new client, to the extent you can retain them, it's a much more efficient business model to hold them for a long time. We regularly see deals that we're weeks away from hitting the wall that we do a financing for. A year later, they get taken out by other lenders, maybe on the panel here. But anyway, we're
we just got taken out on that as well.
I know. But anyway, so where we do well, I think, is establishing the trust. We're not a household name, and we understand that. And how we're really successful is when we meet with someone, providing them references, customer references of, here's 10 names in our portfolio. Call them, ask them what it's like to be one of our customers. Ask them how we react when something adverse happens, because I'll guarantee you something unforeseen will come up in that situation. So, to the extent we can get customers to speak for us, I think it's pretty powerful.
Excellent.
Yeah, it's tough to win that transaction based on relationship because it's just a common term everybody uses on the front end. But the reality is, to me, and I've lived that for LaSalle and into private bank, is you've got to be there for the clients when they really need you. I mean, if there's a problem out there and the company's struggling and they're doing the right thing to try to fix it, you've got to be willing to go to bat for them at risk committee, credit committee, whatever you have, and talk about the reasons you need to keep that credit. And as I mentioned before, there's a lot more emphasis today on, oh gosh, it's a criticized asset, what are we doing with this, and what's the strategy? But for a long-term business model, if you keep those transactions, you're there for them when they need you, you're going to have long-term growth and they're going to be very loyal. And when you start talking about what happens to pricing when these clients do well, it becomes worth a quarter a point or a half a point or even more sometimes if you've been there when they really were down in the dregs. So,
yeah, for us, our relationships, kind of span both ways. We have a lot of relationships with private equity funds, because those are the people that are the deal drivers, and we like to work with people that we've had success with, and a lot of that's reputational. In our business, like your businesses, you want to deal with people that have good reputations and that are truthful. And if we find that, then we're highly likely to go to bat for them and to kind of push the envelope. The ones over the years that haven't been as truthful, we tend not to work together again. But the second half of our business is the relationship is not only on the PE side or the investment banking side, but it's also the bank side. We have 43 banks in the U.S. that are kind of bank partners with us on transactions. All three of the banks represented here are partners with us in our firm. And, we make it a point to be really good partners to financial institutions because, if you think about it, we do something they don't, and they do a lot of things that we don't. Every deal we do, we're not a bank. So we provide credit, but that's all we provide. We don't provide, payroll accounts, operating accounts, wealth management services, letters of credit, foreign exchange. So, we do is we tend to partner up with regulated financial institutions across the country to provide those services to the borrower. And those are very important services to the borrowers. So, most of the time, we're brought in to an existing situation, or the borrower says, we have this banking relationship we want to keep, so can you guys work with them? And over the years, we've got templates in place where we've done that with lots of the regional financial institutions, so it's been a lot of fun. So from a relationship building standpoint, it's good from our seat to see both the borrower relationship, but as well as the banking relationship, and the banks that have been able to understand that and embrace that have been the ones that have been more successful. The ones that kind of early on pushed away, we went somewhere else. Mm-hmm. But now everyone's kind of figured that out, that we're not a competitor, we're just a product extension to what they do, and then they do everything else. So it's kind of been interesting to see that transition over time.
That's a great perspective. I want to touch on one more topic before we open it up to questions. So if we're talking about pricing and structure and kind of the risk management part of it, can you talk about some trends that you might be seeing? Also, look, there's a lot of things happening in the news today, right? And does the possibility of a kind of a black swan historical event, does that ever cross your mind when you're looking at a deal?
Well, it's funny, you talked about a combination of that question and the previous one on regulation. I had a recent political conversation with somebody, and we had our differences in terms of one side of the aisle or the other. But one of the unintended consequences of some of the current administration's actions popped up in one of our customers. You have a contract manufacturer, one day Homeland Security shows up and starts saying, hey, can I see some papers? You know, we got 500 employees, and let's just say the rumor got out, and the next day there were 400 employees didn't show up.
Wow.
And by the time dust will settle, half those employees won't be working there because they're undocumented aliens. Now we can talk about the merits of legality and et cetera, but where it hits home is we're going to see an employer lose half its workforce in a very short period of time. And so that impact, as we go through and visit our customers or our prospects and walk through, you get a sense of, boy, I probably have a pretty good feel who might have some of these issues if Homeland Security pops up in their back door. That's an issue that they talked about in the earlier panel about how tough it is to find, you know, people who aren't smoking crack or doing crystal meth. Well, you know, then you start taking away from it that they're legal residents.
Mm-hmm.
And that's going to have a material impact on the price of labor. And by the way, that labor comes from temp firms who offer 60-day terms. When you have to go find your own employees, they offer 7-day terms.
Yeah.
So that whole working capital side of it's going to come into play. And how big is it? Is this an isolated incident, or is this active effort by the current administration? That could be a big problem for us.
Yeah, that's going to be exciting in the 2018 panel to talk about what happened there.
Yeah.
You know, as far as a black swan event occurring, I mean, there's only so much you can do. Diversify is the first thing that comes to mind. You know, again, you got to pick your spots too. I mean, you look back at the credit crisis, and what do you do how do you value assets from an asset-based perspective when there's no bid for the assets, right? It's almost a binary conclusion.
Mm-hmm.
You know at some point it's going to come back, so you hope you're capitalized the right way, that you've picked the horses that are going to survive, so you can weather the storm. So really hard to underwrite to a specific event like that. You know, pricing and structure, those are the two things, the two levers we have as a lender to compete. You know, luckily with our bank platform, you know, our price, we've got pretty cheap cost of capital. Not as cheap as the guys next to me here, but cheap enough to compete. But when it comes to structuring, you know, we're seeing things, you know, lax reporting. We're seeing no appraisals on, no inventory appraisal requirements, cap on legal fees. So I guess when you look at things, not getting an inventory appraisal, you better be at pretty low advance rates.
Yeah.
Or it's, you know, you're rolling the dice. So, you know, you're going to see the industry dynamics too. I mean, we saw what happened in oil and gas. Luckily, we're not in that space. So I guess the key is all you can do is diversify. And, you know, if we're doing a stretch piece, which we will do on occasion, we're going to get that back pretty quickly. So it's not a cash flow product for us. It's more of a bridge financing. So hopefully it's not out there long enough to, if and when there were a black swan type event, that our exposure's down to a very manageable level.
Right. Bruce?
Yeah, I mean, structures are going to continue to get hammered. I mean, the reality is, and I like to blame the big banks because we're not one of those, but, you know, the volume, disappears in the big bank market, and they come down to the lower middle market, and they bring some of those bad habits, you know, springing dominions, springing covenants, some of those structural things that sort of our middle market customers had never seen before, and then somebody whispers in their ear and says, by the way, did you know you could get this? And, you know, it doesn't work as well in our market, truthfully. And then, you know, we're not doing cash flow loans, but then that same $4 or $5 million EBITDA customer comes up and says, you know, I've been borrowing ABL, but I hear I can get 3.5 times of my $5 million EBITDA, which is insane. But so you're going to have to deal with those things. Fortunately, I think we're built for that. You know, the reality is if we're doing our jobs right, we should, and careful what you wish for, because it's always worse than you think. In fact, Bob mentioned it. I think we both started our groups up about the same time, and the reality was, what was great about that time for us was we didn't have a portfolio to deal with anymore, right? I mean, it wasn't like our portfolios we left behind were perfectly clean. But so you got to be careful what you wish for, because you will have problems in your portfolio. But we're kind of built for that sort of black swan event, that economy that gets a little tenuous, because some of those transactions that were commercial and cash flow are now seeking an ABL solution. So we should want that. In fact, I talk to the regulators every year when they come in, and my pitch was always that ABL is built for every economy there is. If it's a bad economy, we're built for it. If it's a growing economy, we're built for it, because people are outgrowing their working capital and equity and need our help. And I said the only one it really hasn't been built for is the one we're in right now, where it grows like 2% and nobody's reinvesting their money. So, a change may be better, but careful what you wish for.
That's funny. So you were upset at a 3.5 times multiple. We
That's $5 million of EBITDA. That's okay at 10 or 12.
We lost a deal at 6 times where another lender was willing to do a transaction. So, we play in the world of, kind of 3.5 to 5 turns.
Can I get the name of that other lender?
Yeah. It's a...
Exactly. Both of us.
The market's trended this way now. I've said this for the last couple of years. There's not a lot of discipline. Most transactions are being run by investment banking shops. That's how you know when it's a hot market or not a hot market. When the M&A market is driven by investment bankers, and they have the nice books that come out with the calendars with the blocked out dates that says you got to have a proposal in on this date, and you got to have a management visit here, and you have an offer here, you have to have a contract here, and you have to have a markup of that contract by this date. It's a very fast process right now. Everything is fast. Deals are fast. Lending is fast. There's not as much discipline overall in the market. And if there's anything that I think that's going to really be a turn, I don't see a black swan of it. I see something. I see more self-inflicted wounds, frankly, in our business than anything else. And it's just because the pace of the way we're forced to deal today. Now, all of us in all of our businesses, whether you're doing quality of earnings, whether you're doing asset-based lending, whether you're doing cash flow lending, we're forced to move at a much faster pace because everybody else is. Deals that used to take 90 days now take 60 days. Deals that used to take 60 days are being done in 30 to 45 days. And I think that's the greatest risk, because you miss things. We're not immune from it. We try to do a good job. We've developed some pretty good systems over the years, and we have pretty good infrastructure. But when you're forced to move, we had a deal come to us, and I'll give you a perfect example. It was a $100 million revenue company run by a woman, and it was based in D.C. It was a crisis management, kind of PR crisis management firm, and that business, your assets kind of walk in and out every day of the office. It's people, and they've got a great firm. And Ford recently changed their CEO. I don't know if you follow that, but the new CEO coming in called this woman on a Friday, said, "Come to Detroit. I need to talk to you. It's important, and I want to put a plan in place." And he couldn't tell her what it was, and she came out and she said, "I'm going to be the new CEO of Ford, so I need a whole PR plan and a media plan and an operating plan to kind of get the word out and how we're going to do this." So, that was their business. And they had a minority shareholder, a private equity firm, that there was a formula buyout, and they had to kind of hit the formula at the right time, and they had 30 days to kind of exercise on that. And we had to fund it in 30 days. So, we got in, we did our diligence, but it was 30 days start to finish. So that just is an indication of kind of what's in the market. And, all I can tell you is that, just do your, cross as many T's, dot as many I's as you can, because I think that's the highest likelihood of a problem. Not, North Korea is going to be North Korea, and God knows what's going to happen with that, nut job. But, he's been a nut job there for a long time, and he's going to be a nut job for a long time more. But the things that, that we can control are the things that I think we need to focus on. And that's kind of how I view our business.
Yeah, that's helpful. And I think in the last panel, someone mentioned the word discipline, which I like that word. I think that's a strong thing to have. We can probably have 1 or 2 questions here, real quick. Do we have any? You got a microphone right behind you.
Thanks. Can you comment on any issues that you've seen coming out of the hurricane in Texas and whatever's about to hit in Florida? Is that impacting any of your current clients, and how do you think about it on a go-forward basis? Thanks.
I can be real quick. We have very little portfolio in Texas, so I'd say immediately nothing. It's going to have some impact, I think, on fuel prices, maybe some replacement supply of equipment, but for the most part, I'd say for us, very little impact.
I'm still we're still trying to understand our risk in that arena overall with that portfolio in the Houston area. We've got an originator down in Dallas, so we do have some exposure there. Myself, there's 2 deals I'm involved with. One that has manufacturing operations there. Luckily, they're dry. The issue for them is just some of the workers there, had flooding, so it's more of a human resource issue for them than anything. And another one is benefiting it because they do a lot of water extraction work for floods, so it's to the benefit. So it can kind of work both ways.
Yeah, the port was shut down about a week, and it's going to affect sort of fourth quarter for a couple of our customers from a standpoint of deliveries that are going to probably be delayed by obviously a lot more than a week. The South Florida one worries me a little bit more because we've got 6 customers right in the brunt of that in South Florida. So sort of their disaster contingency plans and how they deal with that are going to be interesting because that could be really bad. But, the reality is with the Houston, tragedy is the amount of sort of personal damage that was done to a lot of those residences that's really not covered because nobody got flood insurance for a 1,000-year flood. So, that's going to be interesting sort of economic impact because it's much different when it's coming out of your own pocket than when it's being paid for by an insurance company. But
I'm a glass half full guy. So it's a terrible thing. We have a dozen companies. Our portfolio's good. But 2 things. I think one, the insurance markets are going to get whipsawed hard by this because nobody anticipated this. And people, do have insurance, and everyone's going to hit their insurance claims. So there's going to be dislocation, I think, in the insurance market. Number 2, which is more important, I think, is that I think it's going to be one of the single greatest opportunities of 2017, 2018, these couple of years, because a lot of money is going to go in to that market. There's going to be a lot of federal money. Our president's going to make sure because Texas was a big a state for him. And the Houston market is pretty good in general, the real estate market and the business community there. So I think it's going to recover faster than other areas that have had major catastrophes. So, it's almost because there's so much there, I think it's going to be a huge entrepreneurial boon to real estate people, self-storage people, home improvement people, tradesmen, builders, contractors, transportation, logistics companies, storage companies, industrial businesses. So, my gut as an entrepreneur, because that's kind of what I do, is I think this is going to be a really, really good opportunity for business generally in Houston for the next, year, 12 to 18 months.
So how's that going to work when there's not enough tradesmen right now? That's the part I don't get. Why is there you don't see any of that inflation in the wage side, but.
Yeah, I don't know. I think it's going to, there's going to be a magnetic gravitational pull towards Houston.
It might be Florida after this one.
Yeah, could be both.
Yeah. Go Irma.
Jeez.
I'm kidding.
Any other questions? Well, look, we're a few minutes past. The 4 of you have been more than impressive. Really appreciate you being here. Let's give them a big hand. Thank you so much.
All right, man. Good job. That was fun.
Thank you also to Kirkland & Ellis and their staff, and to RSM for co-hosting, and to all of our panelists. And thanks to all of you for coming. We're honored to have all of you. Thank you.